faster than anything we had seen in decades. It was approaching 1.75%. What we were talking about on the show was the rate at how fast it got there. It was like instantaneous compared to other sell-offs that we've seen in the 10-year Treasury. Since then, we've had a lot of news that's come out. I see David posting Lowe's receipts today on Twitter and showing the price delta of 400% in some of these commodity prices. And everybody's talking about how the home prices are exploding. Any type of inflationary thing that you could think of is going berserk. But unlike what you would expect in the 10-year Treasury, which is it would keep selling off and the yields would go any higher, we've actually seen the exact opposite, where the prices actually started to bid, and now it's at 1.36, and this is only a matter of probably a quarter. So what in the world is happening? Because it doesn't, for a person who's looking at that and seeing the inflation that we're seeing, and it's not like that expectation is disappearing. Everyone's expectation moving forward is that you're going to have more of this. And so what in the world is making the bond market bid right now?
What a great question. So way to jump in right into it, Preston. So here's what I know. That is not truth, okay? There's a $120 billion per month purchaser elephant in the room. They have actually done a pretty magical job of getting the market short and then squeezing it. They're pretty good at trading this thing, I will admit. So everybody and their brother was shorted. It was the largest short interest by certain metrics that you've ever seen. And rumor has it, according to the Bear Traps report, that there was one massive account that capitulated and bought it all the way down to 125. So all I'm going to throw out to you is, who cares? 125 or 175, you're talking basis points. Basis points are for kids. Don't mess around with basis points. The reality is there's a $120 billion elephant in the room. That market itself is not even true. If you listen to Stan Druckenmiller, the proper rate on the U.S. Treasury right now without the Fed being involved would be closer to 3.5% in the 10-year. And Stan Druckenmiller is way smarter than I'll ever hope to be. So let's go with his viewpoint as what the proper rate would be. The 175, 125 just so happens that 125 was a technical indicator. If I'm not mistaken, it's the 200-day moving average on the 10-year. So markets always go in the direction that causes the maximum pain to the most people. And the most people were shorted, and it went from 175 back to 125. The one thing I would love to leave you with is inflation expectations are not what we need to look at right now. It's credit default. The component of the 10-year that is made up of credit risk rather than inflation risk is what the world needs to focus on right now. Now, I know it sounds like it's a de minimis amount in the U.S. 10-year. Right now, the CDS market, the credit default swap market for the U.S. Treasury is about 10 basis points in the 5-year tenor. The point is this, it's going to move, it's going to get bigger, and inflation expectations are going to be overwhelmed by credit default risk. Very simply, you see it with other countries. The U.S. will be the last market to capitulate, but you're going to see contagion that'll flow through from other countries. So we got to remove the focus on inflation expectations, whether they're real or perceived according to a CPI, and you got to focus on an open market called the credit default swap market. So that's what I would say to this. 175 versus 125 basis points in the 10-year, that's trading levels. You got big accounts that got caught offside. It was the point of maximum pain, and all of a sudden it's rebounded right back to 135. Again, it's noise. The range in 10 years is higher because of credit risk, but not because of inflation expectations. The Fed will control the inflation narrative. They will not be the credit.
Stan saying that the proper rate is this 3.5% if central banks aren't involved. But they are. They are involved. And not only are they involved here in the U.S., but they're involved at the ECB, they're Bank of Japan, over in China. So you have these major central banks that are at play. Let me run this idea past you. So I just tweeted out this picture that Yardini, I think we talked about this last time I was on, where they plot out all the total assets of major central banks and they compare them side by side with different colors on the chart. This one was on the x-axis is time, and on the y-axis it's denominated in trillions of dollars. and then it's these various colors for each central bank. On this one in particular, it does a good job of keeping the same y-axis. I don't like the ones where the y-axis is different on each side. This one here, you can really kind of see, because it redenominates all the currencies into the same US dollar currency, and it's an apples to apples comparison of how much they're adding to their balance sheet. When we look at this and we look at what's happened in the last 6 months, the ECB has absolutely gone bananas on the amount of printing and debasement that they've done with the euro. And so when we think about kind of the last time that Greg and I were talking, the ECB hadn't basically kicked on ludicrous speed with their debasement relative to what I think this is really important, relative to what the Fed was doing. They were kind of moving at the same pace. But ever since probably, I'd say, when the second quarter started of this calendar year that we're in right now, the ECB has just taken off and the Fed has gone at a much slower pace. So this means the dollar is going to get stronger relative to the biggest fiat currency competitor out there, which is the Fed, right? Is that appreciation in the dollar relative to the euro the thing that's making the treasury market kind of perform in the way that it's performed, which is it's been bidding?
First, I would say one should never lose sight of the fact that all these systems look like emergent systems to me, where they can make sense right up until that moment when they don't. When LTCM went to hell in a handbasket, you've got these super level of correlated behavior, and it's like trying to predict thunderstorms or something. It just does not make sense. Druckenmiller's an optimist, in my opinion. I've tweeted this several times. I said, imagine you had to buy a 30-year bond. I don't care about the 10, the 30. Let's use the 30. And I said, imagine you had to buy the 30, but you had to hang on to it for 30 years. And you couldn't hedge it, and you were guaranteed to be paid, but the future is a complete unknown. The one thing you had to do is say, what am I willing to accept as an interest rate for 30 years? And the collective wisdom of the social media is well over 7%. And I would say that if I had more spaces in the poll, there would have been people shooting up to 12 or 15, I think. The bottom line is I wouldn't accept 3% return on a 10-year by that model. And so I think Druckenmiller's model is not correct either. And again, he's smarter than me, but Lacey Hunt's smarter than the two of us combined potentially, and he would put the 10-year at 1.1 or something. And I do occasionally chat with Lacey, and I don't push back because he's too smart.
I agree with you. He's really smart. He's really smart. But at the end of the day, I think the people that are participating in this market are people that aren't thinking in 30-year terms. If you had 100 of them in the room, 99 of them, maybe more than 99 of them, are not there for 30 years. They're there to put the trade on and directionally try to be on the right side of it as it bids or sells off.
In 15 minutes.
That's right. Or for whatever duration they're trying to, time the market. So they're just speculating. So you could make the argument the entire bond market is a speculative place these days.
So this is the cool thing you guys are hitting on. There's actually no such thing as capital gains in bonds, right? Everyone says I own bonds because I'm going to be the world's greatest trader and I'm going to buy it at 1.75 and sell it down to 1.25. And the reality is it never happens because all you're doing is cashing out a coupon on your trading prowess. The greatest thing that you just mentioned, Dave, from a former bond trader is that you said you wouldn't buy it at 3% and it's currently trading at 2% in the 30-year. That 100 basis points in the 30-year is worth 20 bond points. Isn't that remarkable? 20 bond points because of duration and convexity.
Yeah.
And so what I love about the analysis that you just laid out is that you would buy it down 20%. And let's go to an extreme and say, if the 10 years at 3.5, and let's just say the 5 years therefore at 5%, that 300 basis points, it doesn't even compute. You've lost 50% of your value in a long-term trade your lives. Because when I started, 10-year rates were at 14%, and they went percent and below. So bonds are a misunderstood money managers in today's day and age.
We're not boomers. You're not a boomer.
That's correct. And the crazy thing is, even Ray Dalio, who's so brilliant on this and made so much money on a risk parity trade and risk parity hedging, he understands the bond math. He's just not calling out people on the bond math, right? He understands it for the ludicrous nature that it is. It used to be when equities sold off, bonds would get bid because interest rates would go down. But we've reached our floor in interest rates, and that correlation doesn't work anymore. Ray needs another non-correlated asset. I wonder what that could be. Let's just sit back and can understand. I want to put one more thing. You're so right, Dave, because what you have not even brought into the analysis is you lend a U.S. Treasury $100 today for 10 years. It's almost certain you're going to get your $100 back in 10 years. Not 100% probability, very high probability, but the purchasing power of that $100 that you lent them today is going to be like $65 in today's dollars.
If you're lucky.
10 years.
Right.
That is why you need to hedge yourself against the certainty of fiat contract debasing. Best thing I could advise anybody out there, do your math. Understand that you should have a lower exposure to bonds than you've ever had in your career over the last 30 years. It's pure mathematics.
So, David, you mentioned Lacey. So I listened to the interview that Lacey did with Grant. He's obviously brilliant, smartest guy in the space for decades. If I was going to say the thing that I think he's missing, and I obviously want to hear you counter this, I don't think that he's accounting for there being an alternative to fiat currencies globally. His model is based on there only being fiat currencies moving forward. My model is based on this idea that that's about to be disrupted. And because of that, we see the solution, we see the pricing mechanism of fixed income particularly, and equities, because I could go down how that would then fall out into equities, as being grossly mispriced. But the fundamental linchpin of all this is this idea that the model that we're accustomed to over the last 30 to 40 years, ever since 71, when you come off the gold standard, that model and how we understand this homeostasis between fiat currencies is about to be disrupted. And as long as it's only fiat currencies, and as long as, the euro's printing faster than the dollar, therefore the dollar's bidding, oh no, now the Fed is printing faster than the euro, so that whole model gets flipped upside down. If there's this alien type technology that enters itself in and starts to say, no, I'm sound money, I can't be debased, I'm immediately spendable up to any amount. If you want a really high transaction, let's say you want to send $100 million somewhere, that might take 10 to 30 minutes at $5 of an expense. If you want to immediately clear, like in El Salvador, and you want to transact in dollars and receive in dollars, but use the backbone of Bitcoin, that nobody even understands how that's happening, at least from the user's perspective, it immediately clears at $100 value. That's happening today, like right now. And so, like, I'm looking at it from that lens.
I don't have a problem with that view. I think that the system, what I learned as a chemist, is that when you push a system away from equilibrium, way far away from equilibrium, the return trip tends to be violent, destructive, gives off a lot of heat. So in a chemistry community, you blow up your lab, avalanches, you destroy villages, earthquakes, you clip California off into the ocean, right? Any system that return to equilibrium, which has got a huge pent-up potential energy, is going to do destructive things. What's also true is they tend to get very shock sensitive. There was a great metaphor, analogy, aphorism, whatever you call it, by Richard Russell years ago when someone said, why can't the system go on forever? And his response was, go into your kid's room and start stacking blocks. He says, just keep stacking. And what you discover is, anyone who's ever done this, is the higher the stack, the more shock sensitive. So pretty soon, Russian bond defaults can tip over the system, as we saw in the late 90s, for example. So when a system gets shock sensitive, and I think we can all agree that the system is heading for shock sensitivity of a higher order, right? I'm not convinced we need a revolutionary technology to trigger the badness. You guys may have the solution to how to avoid that. We're about 99.9% on the same page in terms of what we have to not get hurt by. We don't want to be hurt by. One of the things I learned in 2020, and I think the bond market is a sign of inflation. I once told a prominent hedge fund manager many years ago that the bond interest rates were low because of inflation. He totally blew me off, and now he writes about that. And it's just that the money started chasing bonds. So the hot money went after bonds, and that you say there's no capital gains, but they certainly get bid up. And the money started chasing the bonds, and you could leverage up, and you could buy corporate bonds, and you could sort of make something on the spread, and everything worked fine. By the way, I'm not as enamored with Ray Dalio as some people. Dalio's system works fine as long as you're pumping money all over the system, but his risk parity model, I think, is kind of hokey. I think it's a way to justify inordinate leverage in the bond market that he shouldn't be doing. If you want to call it risk parity, if you really want to send the bond market to the level of risk of the equity market, I think you're asking for a mushroom cloud at some point. And I think they've created that. We've had a 40-year bond market that's been nothing but good news for 40 years. But now we've reached the end of the road. Now 60-40 portfolios, you get precisely zero on your 40 almost, unless you want to go to Argentina to get a bond or something. And so your 60-40 is guaranteed to, at best, high, at best make even on inflation on the 40. And the 60 is probably 130, 140% overvalued. And so we can agree that the conventional alternatives just suck.
Let's take a quick break and hear from today's sponsor.
All around the world, tech companies are innovating and driving returns for investors. Our Crowd analyzes companies across the global private market, selecting those with the greatest growth potential, then brings them to you.
Their in-depth due diligence includes meeting with management teams and generally comprehensive vetting of deals.
From personalized medicine to cybersecurity to robotics, quantum computing, and more. In state-of-the-art labs, startup garages, and anywhere in between, Our Crowd is identifying innovators so you can invest when growth potential is greatest, early. Our Crowd's accredited investors have already invested over $1 billion in growing tech companies, and many of their members have benefited from the 46 IPOs or sale exits of their investments. Once Our Crowd has selected a deal, they offer accredited investors the opportunity to invest alongside them with the same terms. As you review deals, you have access to Our Crowd's investor relations team, who you can talk to directly on the phone about your personal investment goals. Now you can truly diversify your portfolio by investing early in innovative private market companies at Our Crowd. Join the fastest growing venture capital investment community at ourcrowd.com/study. That's ourcrowd.com/study.
Hey, small business leaders, are you looking for an easier way to onboard and manage remote employees? JustWorks makes it easier for you to start, run, and grow a business. Let me tell you how JustWorks can help your business. JustWorks is the ultimate HR platform for small and growing businesses with simple software and expert support for benefits, payroll, HR, and compliance. Across the country, small businesses with big dreams love JustWorks for its simplicity, intuitive platform, and time-saving features. Whether your team is remote or in person, you can give them access to national large group health insurance plans and manage onboarding, payroll, PTO, and compliance all in one place. Sure, you can do it all, but why do it all alone? Learn how JustWorks can help. With JustWorks, you can onboard new employees with ease, take the guesswork out of employment and tax regulations, access national health insurance plans, and save hours on time tracking that syncs with payroll. And don't worry, they have 24/7 expert support. So find out how JustWorks can help your business by going to justworks.com. That's justworks.com for more information. I don't know about you, but I don't love the idea of big data to the point that everyone knows everything you're doing all the time. For example, did you know that if you set up shop at a cafe or a hotel or an airport and you connect to their Wi-Fi, everything you're doing is being looked at by somebody else? Honestly, in this day and age, a smart 12-year-old could hack your computer with cheap hardware. And here's the thing, your data is valuable. Hackers can make up to $1,000 per person selling personal info on the dark web. So that's why for my online insurance needs, I use ExpressVPN. ExpressVPN creates a secure encrypted tunnel between your device and the internet. Hackers can't steal your personal data. And since I'm not very tech savvy, I love the fact that you can just fire up the app and click one button to get protected. It works on your phones, your laptops, tablets, and more. And you can secure your online data today by visiting expressvpn.com/TIP. That's expressvpn.com/TIP. And you can get an extra 3 months free. expressvpn.com/TIP. All right, back to the show.
I completely agree with everything, especially Ray Dalio risk parity stuff where levering into the bonds. Like, that's nuts right now. Are they continuing to kill it because the trend for the last 40 years is still the yields going down?
It hasn't the last few years of his portfolio been somewhat.
I think that's right.
But here's the other thing, guys. It's only mathematics, right? Look, you can lever in a downward trending interest rate environment because in his volatility model, bonds had lower vol. If you measure risk by volatility, which isn't always the best way to measure risk, then his model sold. And that's the key, right? It was simple to understand and simple to model when he was showing it to pension allocators who bought into that model. He admits that it's no longer there. He said himself, I'd rather own a Bitcoin than a bond.
Yeah.
I don't know what else to say.
He supports both. He is on record both. Dalio does this macro analysis. I hope he's not listening.
Why?
He does this macro analysis that seems pedestrian to me. I mean, I listen to him, I go, oh, I don't go, what a wizard. It seems like he's just skim coding some basic principles. And I think that he grew his entire empire under this optimized situation that was set up by interest rates starting at 16%. And
Amen to that. You're exactly right.
And it's sort of like Peter Lynch became a rock star by entering equities in about 76 and getting out in around 2000.
And sending his kids to the mall and telling him what is selling in the malls so that he could figure out.
Cinnabon.
You're so correct, Dave. I've never been more proud of a chemistry professor in my life, okay? Because you understand the bond market, which is like, you're in the 99th percentile. Even the fund allocators don't understand bond markets. It's that simple.
Prices up, rates down. Isn't that
well, not only that, how about this? If something is a straight line down from top left to bottom right with no volatility, right? It's a straight line. Does that mean there's no risk? No. But that's how everyone measures risk, is by the volatility. Like, my Lord, people have lost their friggin' minds in terms of how to measure risk.
It goes back to what you were saying earlier about pumping all the energy into something. For 40 years, they have done nothing but pump all this energy straight into the fixed income market through bidding the prices to the moon and the yields down to nothing. And here we are, in the U.S., nominally the 1.36, but you go to other parts